Welcome back to All Things Money. During today's show, we're taking a look at some of the lessons learned from the so-called lost decade of the past 10 years in investing. One of the lessons that we want to learn from the past decade was to use diversification to spread your risk. As I mentioned before the break, the individual stock selection has been very difficult the past 10 years, and the returns have mostly been contained within the overall market, industry, country, sector, what have you, that the company has been in. But we still recommend that you use large-scale diversification. Once again, you're looking at having small companies, large companies, companies that are growing fast, some value companies, having investments overseas. The S&P 500, which is usually the statistic referred to when talking about the lost decade, is made up of the 500 largest companies in the United States. It is what's called a capitalization weighted index, and I won't go into all the details of it, but essentially what it means is that the top 10 or maybe 20 companies essentially drive the return of the whole index. So for example, right now ExxonMobil is the largest company in the S&P 500. It accounts for somewhere around 3% of it. And so if ExxonMobil has a good day or a bad day, it has a larger effect on the S&P 500 than much smaller companies. And so what we mean by diversifying is getting away from the S&P 500. I think it's a really bad index. Unfortunately, Standard & Poor's has done a phenomenal job of marketing their index. People talk about it all the time. It's index. It's promoted on CNBC, but it's a terrible index unless you're trying to capture the U.S. large cap, top 10 or 20 companies in the country. Much better indexes are things like the Wilshire 5000, maybe a equal weighted index. There's some movement towards equal weighting where each company in the index receives an equal weight. And there are drawbacks to that as well, but what I'm driving at is don't get wrapped around just the S&P 500. There are all sorts of other investments, both in the U.S. as well as around the world. We advocate having a substantial amount of money overseas. Even though the world is very globally linked, and during the market crash of '08, international companies went down a lot as well, the fact of the matter is emerging markets have had a positive net return the past 10 years. There are other countries around the world that have had a positive net return the past 10 years. It's just not the U.S. and just not Western Europe. But there are countries and places around the world that have had a positive return. And so right now the United States makes up approximately 50% of the world, somewhere between 40 and 50% of the world's market cap. And therefore your portfolio should have somewhere around 50% invested overseas. It's just prudent diversification. The other thing that the past 10 years should remind us is that bear markets are part of investing. If you're not prepared to go through a bear market, then you probably shouldn't be investing in stocks at all. Now, as we mentioned, there are ways to mitigate it: diversification, international exposure. We recommend that for everyone but the very most risk tolerant and maybe some very young people, that everyone have some sort of fixed income in the portfolio. Something to help buffet the ups and downs of the stock market, where you can earn a return, preferably if you have an IRA or 401k, where the income that fixed income throws off can be tax deferred. You would place those type of securities in those accounts. But we found that adding in even a moderate amount of fixed income to an aggressive portfolio significantly enhances the returns. By the same token, adding some stocks to a very conservative portfolio also enhances the return. That having a 100% fixed income portfolio is very a suboptimal strategy. One of the other lessons that we learned is to be flexible. It's very rare for a person to be able to buy and hold through the past 10 years. And so if that is not your temperament, we suggest finding some sort of strategy that you can live with. Some sort of strategy that moves you out of the market when you're uncomfortable. Now, we don't advocate this to beat the market. It's very difficult to beat the market over long periods of time. Numerous studies have shown that it's very difficult to beat the average of the stock market. However, on a risk-adjusted basis, it may be a prudent thing for you to do. If you're not trying to beat the market and you're trying to make the highest return, but you want a portfolio that meets your risk requirements, the first thing we recommend is to add some fixed income to help moderate the declines of the portfolio. If that's still not enough moderation for you, there's nothing wrong with moving your funds, lightening the amount of equities in the portfolio, or moving funds away from the equity. Just understand that you're probably not going to beat the market in the long term. On a risk-adjusted basis, you will. That if you look at the amount of return you receive and the risk that you take, it can be very beneficial. So, for example, if the market returns 10% and you're invested 100% of the time, and you get out of the market, say 25% of the time, and you make 9%, well, on a risk-adjusted basis, you did much better than the market, and there was a certain percentage of the time you were not exposed to the market. Well, we feel that's perfectly acceptable if that meets your risk tolerance. When we come back, we'll finish up with this topic, as well as hopefully have some time to get to some of your emails.